Many young people ask me the actual secret to building massive multi-generational wealth, and I tell them the absolute truth, but nobody wants to believe it. Everyone loves the comforting lie of safety and traditional prepackaged financial products, while their hard-earned cash is silently being incinerated by inflation and excessive fees. We have been conditioned to believe that investing is this incredibly complex system requiring expensive suits and confusing jargon designed to keep you dependent. The reality is that your wealth accumulation boils down to simple mathematics and basic human psychology. I recently looked at an everyday investor named John who had a simple $10,000 deposit and the exact same 3 premium Fidelity index funds available to everyone. Depending entirely on how he structured the internal weights of that portfolio, John could create 2 completely distinct financial realities for his future. One specific configuration would pay him over $2,000 every single month for life in pure hands. Free dividend distribution cash. The other exact same selection of funds with shifted percentages would explode into an absolute monster account worth nearly $700,000 on paper. I want to break down exactly how this math works, so you can stop being a passive spectator in your own financial journey. We are going to dissect 3 specific funds, which include one optimized for dividend distribution, one built for pure aggressive growth, and one designed for global international diversification. Before we look at the raw numbers, let us establish exactly what a passive index fund actually is without the industry marketing fluff. An index fund is simply an automated basket of corporate securities that follows a strict, predefined mechanical rule with zero expensive human management. There is no highly paid fund manager sitting in a glass tower trying to predict the future or pick individual corporate winners. The fund simply buys and holds whatever stocks exist inside the underlying index it is mandated to track over time, because human error and expensive salaries are completely removed from the equation. The operating fees drop down to almost absolute zero. This ultra-low fee structure is the primary reason why simple passive index funds consistently outperform active Wall Street professionals over long historical horizons. Let us examine the first critical tool in John's investment arsenal, which is the Fidelity High Dividend Electronic Traded Fund, known by the ticker symbol FDV. This specific financial instrument is constructed with the explicit mechanical mandate to harvest consistent immediate cash flow from massive corporate entities. It systematically tracks large and mid-cap United States companies that display a proven track record of paying out robust dividends while expanding those distributions over time. When you look under the hood at the absolute top holdings, you will immediately spot household technology giants like Nvidia, Apple, Microsoft, and Broadcom. If your immediate reaction is to wonder why massive tech enterprises are sitting inside a dedicated dividend fund, you are thinking like an amateur. Most casual investors mistakenly picture dividend funds as a sleepy collection of boring traditional utilities and old-school regulated energy providers. But the modern reality is that these dominant technology juggernauts have grown so incredibly massive that even a tiny sliver of their total net profit equates to billions of dollars in cash distributions. Apple alone distributed over $15 billion in pure cash dividends to its aggregate shareholders over the course of last year. So this specific fund is not recklessly chasing high artificial yields from dying legacy enterprises with broken business models. It is systematically accumulating ownership stakes in the most fiercely profitable capital-efficient monopolies that have ever existed in human history. A dividend is simply a direct slice of actual corporate profit that gets legally distributed back to individual shareholders, usually every 3 months. The mathematical formula here is beautifully simple, because the more total shares you control, the larger the physical cash check you receive. The High Dividend Fund currently operates with a baseline dividend yield of 2.2% alongside an exceptional 5-year dividend growth rate of 10.85%. When you combine that cash generation with a historical annual share price appreciation of 9.6%, you possess a formidable income engine that handles the first major objective of our asset allocation strategy, which is immediate defensive cash generation. Now, John needs to introduce a hyper-aggressive growth component to maximize the compounding velocity of his principal capital. The second vehicle is the Fidelity NASDAQ Composite Index Fund, which operates under the mutual fund ticker symbol FNCMX. This specific fund is engineered to expand the aggregate size of the investment account as rapidly as humanly possible by riding the wave of technological disruption. It tracks the performance of the entire NASDAQ Composite Index, which comprises roughly 3,000 distinct corporate entities heavily weighted toward technology and digital innovation. We need to clear up some common confusion right now because many retail investors mistakenly assume the NASDAQ is an individual company or a specific product. The Nasdaq is simply a digital stock exchange where the most progressive, innovative enterprises on the planet choose to list their equity shares for public trading. Because modern technology platforms dominate the contemporary economy, a fund tracking this specific exchange becomes heavily concentrated in world-changing tech enterprises. The primary holdings inside this vehicle feature familiar dominant giants like Apple, Microsoft, Nvidia, Amazon, and Meta platforms, while the previous dividend fund owns these same enterprises for their cash distributions. This growth fund holds them for their explosive capital appreciation potential. The total technology sector concentration inside this growth vehicle sits at an aggressive 50% of the aggregate portfolio weight. The raw data perfectly reflects this structural growth orientation because the fund yields a tiny 0.48% in direct dividend distributions. However, it compensates for that lack of immediate cash flow by delivering a spectacular historical annual share price appreciation of 17.45%. That 17.45% figure represents the highest capital expansion rate among all three funds analyzed today. So John now possesses an incredible dual engine of immediate defensive income and aggressive long-term capital appreciation focused inside the United States. But relying entirely on one single geographic economy is a dangerous psychological trap that exposes you to massive localized systemic risk. A truly bulletproof wealth strategy requires robust global diversification, which brings us to our third essential vehicle, the Fidelity Total International Index Fund. Operating under the ticker symbol FTIX, handles everything outside the borders of the United States. This extensive fund tracks over 5,000 individual corporate equities across both highly developed foreign markets and rapidly emerging global economies. Developed markets include mature, stable nations like Japan, the United Kingdom, and Germany, while emerging markets capture high-growth regions like India, China, and Brazil. The top corporate holdings inside this international basket will not be household names to the average domestic consumer. You are purchasing stakes in global powerhouses like Taiwan Semiconductor Manufacturing Company, Nestle Novo Nordisk, and ASML Holding. Many young investors look at the recent charts and, tempted by recency bias, completely skip global international exposure altogether. International equities have visibly underperformed domestic United States corporations for more than a decade, leading people to assume they are trash. But skipping international exposure means you are making a massive unhedged bet that America will maintain absolute economic dominance forever, without hitches. If the domestic United States economy experiences a prolonged stagnant decade of stagflation, this international fund acts as a vital floor for your wealth. There is an incredible hidden characteristic under the hood of this international index fund that almost nobody in the mainstream media talks about. The fund provides a robust baseline dividend yield of 2.54%, while generating a historical annual share price appreciation of 6.2%. But the real kicker is its phenomenal 5-year dividend growth rate, which currently sits at an astonishing 16.98%. Think about that irony, because the international fund that everyone ignores actually features the fastest growing dividend distribution of all three vehicles. Now, John possesses all the necessary raw components, which include domestic income, domestic growth, and comprehensive international diversification. But here is the massive structural crossroads where the vast majority of amateur retail investors completely lose the game. Simply selecting a high-quality collection of index funds is only 20% of the actual wealth allocation puzzle. The real determining factor of your long-term financial destiny is how you choose to weight each individual asset relative to the whole. You can take these exact same three Fidelity products and construct two entirely different economic engines with completely opposite outcomes. If you tilt the proportional weights in one direction, the portfolio transforms into an immediate cash-generating machine that funds your lifestyle. If you shift those exact same funds in the opposite direction, the account transforms into an absolute mountain of paper net worth. Same $10,000 original capital, same three baseline Fidelity index funds, but a completely different strategic destination based on simple weighting. Let us map out the exact mathematical trajectory of the dividend-tilted portfolio configuration designed to maximize consistent lifetime cash flow in this specific income focus setup. John allocates 50% of his total capital into the International Index Fund. He then places 30% of his money into the High Dividend Fund and leaves the remaining 20% inside the Nasdaq Growth Vehicle. Your initial psychological reaction might be confusion as to why the International Fund receives the absolute largest slice of an income portfolio. The mathematical rationale is crystal clear, because the International Fund boasts the highest compounding dividend growth rate at 16.98%. Over a multi-decade horizon, that hyper-aggressive growth rate acts as the primary compounding engine to expand the total cash output. The dedicated high dividend fund receives a 30% allocation to establish a strong immediate baseline yield from day one. Meanwhile, the volatile Nasdaq growth fund is suppressed to just 20% because this configuration does not prioritize rapid account balance expansion. In this scenario, the tech growth fund serves as a modest internal anchor designed to ensure the total principal balance does not stall out against inflation. When you blend these three specific weights together, the total portfolio produces a baseline blended dividend yield of 2.2%. It delivers a blended annual dividend growth rate of 13.13%, alongside an annual capital share price appreciation of 9.14%. Let us track exactly how that $10,000 initial deposit compounds over a standard 30-year human working horizon. After the very first year of cold patient compounding, John's $10,000 has grown to a modest $11,134. There are no fireworks, no insane social media flexing, just the quiet, invisible work of basic arithmetic. After 10 full years of disciplined holding, the total projected account value expands to $30,453. By year 20, the steady compounding process starts to hit the vertical part of the exponential curve, reaching $103,773. When the clock finally hits year 30, the total aggregate value of John's dividend-tilted account reaches a substantial $416,600. But the total paper size of the account balance is not the real headline or the actual victory of this specific strategy. The real triumph is the massive volume of cold, hard cash that this specific engine is systematically pumping out every single month. In year 30, this dividend-focused setup is projected to pay John a staggering $2,048 every single month for the rest of his life. That translates to an annual cash flow of $24,500 cascading directly into his bank account, completely independent of market volatility. Whether the broader stock market is crashing, entering a brutal depression, or flying to the moon, those corporate dividends keep distributing cash. When you dissect that final $416,000 balance, you discover that $255,000 came from natural share price appreciation. The remaining $1,005 was generated entirely by the mechanical process of systematic dividend reinvestment. Dividend reinvestment means that whenever a company pays you a cash dividend, you do not spend it on cheap material consumer trash. You immediately use that cash to automatically purchase more fractional shares of the underlying index fund within your account. Those brand new shares immediately start generating their own independent dividends, which then turn around and purchase even more shares over time. Over a 30-year timeline, that snowball effect becomes an absolute unstoppable force of nature within an individual portfolio. Nearly 37% of the total aggregate growth in this setup comes directly from dividends compounding completely on top of themselves. That means nearly 4 out of every $10 accumulated inside the account was generated entirely by internal cash generation, rather than market luck. That is the exact roadmap for the income-focused model, which gives you a projected $4,000 balance and $2,000 a month in cash. But John knows there is an entirely different version of himself watching this play out who does not care about a monthly dividend check. This alternative version wants to maximize raw total net worth to build the absolute largest possible pool of capital by the end of the timeline. So what happens when John takes those exact same 3 Fidelity index funds and weights them in the complete opposite direction? The structural proportions flip entirely, with 70% of the total capital flooding directly into the Nasdaq Growth Fund. He allocates 20% into the High Dividend Fund and drops the international diversification down to a minimal 10% slice. The underlying investment logic shifts completely because the primary goal is now raw, unadulterated capital appreciation over time. The Nasdaq Growth Fund receives the dominant 70% weight because its 17.45% appreciation rate beats the other funds by a massive margin. The High Dividend Fund is slashed to 20% because immediate cash distributions are no longer the objective of the portfolio. The International Fund drops down to a tiny 10% hedge, serving merely as a safety net rather than a primary driver of compounding. With these aggressive new growth weightings, the total blended portfolio operates with a lower baseline dividend yield of 1.15%. The blended dividend growth rate drops to 8.71%, but the annual capital appreciation rate surges to 14.67%. In this specific growth configuration, that 14.67% appreciation rate is going to do all the heavy lifting. Let us run the exact same 30-year compounding math on this growth tilted engine to see the stark divergence in outcomes. After year 1, the growth portfolio is worth $11,005 which looks almost identical to the dividend version. But as we cross the 10-year milestone, the mathematical gap begins to open up wide as the portfolio reaches $42,004. By year 20, the explosive power of tech-driven compounding completely pulls away, reaching $1,009 and by the time the 30-year clock runs out, the growth tilted portfolio is projected to hit a massive $6,005. This is where the structural divergence between the two strategies becomes incredibly obvious to anyone analyzing the data. Out of that massive $6,000 total balance, a staggering $6,000 was generated entirely by pure share price appreciation. A measly $14,001 came from dividend reinvestment, because this portfolio simply does not generate meaningful internal cash. 98% of the total financial growth in this portfolio exists purely because the underlying stock prices went up on a chart. This represents a completely different classification of wealth, because it is paper net worth rather than direct cash flow in your pocket. This structural trade-off becomes painfully obvious when you look at the monthly income generation at the end of the 30-year cycle. By year 30, this massive growth-tilted portfolio is only generating $98 a month in actual dividend distributions. For the entire calendar year, that amounts to just $1,001 in total, realized cash income from a nearly $7,000 portfolio. That is the ultimate psychological trade-off, which gives you a much larger paper account balance, but an absolute pittance in real world cash flow. Let us place both completed models right next to each other so we can look at the raw reality of your financial choices. Same initial $10,000 capital, same 3 high-quality Fidelity index funds, same exact 30-year timeline on the clock. The dividend tilted setup reaches $4,000, while generating over $2,000 every single month in pure cash flow. The growth tilted setup climbs to nearly $7,010, while generating a pathetic $98 a month in cash flow. The larger paper account balance yields over 20 times less immediate monthly income than the smaller dividend-focused account. I know there are amateur math experts watching this right now who think they can easily outsmart this dilemma using traditional financial guidelines. You are probably calculating that a 4% safe withdrawal rate on a $7,010 account yields $27,000 a year. That breaks down to roughly $2,003 a month, which technically beats the dividend portfolio cash flow on paper. So you assume the growth portfolio is still the superior choice for retirement income, because the absolute paper math looks better. That perspective is an incredibly dangerous theoretical trap, because paper math behaves completely differently when applied to real-world human lives. The 4% rule is merely an academic guideline, which states you can theoretically sell off 4% of your portfolio each year without running out of cash. But look at what happens in actual practice when you are forced to live through a brutal, volatile, real-world market cycle. With the dividend portfolio, John never sells a single share of his underlying investments to pay for his daily life. The $2,000 a month arrives as pure excess cash distribution from corporate earnings, while his base shares remain completely untouched. The underlying investment machine stays fully intact and continues to generate cash flow forever, regardless of broad market sentiment. With the growth portfolio, John is completely forced to manually liquidate a portion of his shares every single month to generate spending cash. If the stock market enters a brutal multi-year bear market right when John retires, he is forced to sell his shares at a massive catastrophic loss just to pay rent. This destructive financial phenomenon is known as sequence of returns risk, and it is the single biggest reason why wealthy retirees still run out of money. When you are forced to sell depreciating assets during a market downturn, you permanently cannibalize the underlying engine of your wealth. Neither of these portfolio structures is inherently right or wrong because they represent two completely different strategic bets on capital. If you are young and decades away from retirement, prioritizing raw paper appreciation might make perfect sense for your timeline. But if you require reliable, consistent financial independence that funds your real life right now, cash flow is the only metric that matters. Stop blindly chasing a massive paper net worth figure just because it makes you feel important on a spreadsheet or a social media profile. Understand the hidden mechanics of the financial instruments you are purchasing and structure them to serve your actual human life requirements. The corporate financial complex wants you to remain confused, so you keep your capital locked up in generic passive products forever. Break free from the traditional dogma, run the actual numbers yourself, and build a machine that serves your specific personal goals. Stay boring with your asset allocation. Stay patient with your long-term execution piece.